This is Broke Money Hustle. And now, here's Broke Money Hustle with Trico and Eric.
Hello. Happy Monday to those of you who haven't looked at your brokerage accounts, and unhappy Monday to those of you who have. Yes, we are having a bear market day. As always, I am joined by my co-host, Trico. This is Broke Money Hustle. It's a podcast for regular people with not much money, but you're trying to grow that money by investing it, buying assets, paying yourself, saving, gold, silver, crypto. We try to talk about a little bit of everything, and we're learning. So we're just kind of sharing our experience as a podcast, learning along, so you can learn along with us. Please don't copy our mistakes. If you have some money you want to put in the market, contact a financial advisor. We are not financial advisors. We're just stumbling around in the dark and hoping you enjoy the trips and falls. How you doing today, Trico?
I'm doing all right. My portfolio has seen better days, but
yeah, I know. I was checking out my Robinhood today, and it's down for the past 3 months. It's down almost 7%, which I don't like seeing that at all. But we have these up days, we have these down days, and down days are when it's on sale. Mm-hmm. The thing that everybody wants to know is like when they're going to go back up, which we can never predict. What's going to happen? We have an election coming up. We have an article that kind of sheds some light on that here coming up in a little bit. And then, so they the only highlight for me was seeing Workforce. They have the UPS contract. That stock has doubled what I had paid for it.
Nice.
And I'm pretty happy about that, trading at just under $30 a share. I got into Workforce at $15. Would have been nice to get on the $3 mark earlier on in the year, but
Yeah. That was one of my big follies. Was I bought it back in June for $3 and some change, and then it didn't do anything, and I was like, I don't need this. I got rid of it.
Yeah, and it's one of those things you want to buy and hold. You never know what's going to happen. And they're supposed to get the USPS contract too. I've heard that rumor. So it could be, it still could be a good time to get into Workhorse. They do EV. So this is basically Workhorse is replacing the fleet of UPS with EV vehicles. That's what's going on with Workhorse. That's what Workhorse does. And seems like a great company. Been doing pretty good so far. Happy to have them on board with my EV portfolio next to my Tesla stock that refuses to gain past what I bought it for. That was my FOMO. That was my biggest FOMO mistake of the year, was buying Tesla after the split and not letting the hype die down, because everybody was waiting to buy it after the split.
Yeah.
So of course we all bought it at the high price. It got down as low as like $350, I think. Currently trading at $431.79, and but at least I can look at Nvidia, Square, and now Workhorse, and it's like, yeah, I'm glad I have those. Everything else is in the red.
I hear you there. Mine, almost everything's red. Coke is doing pretty well, but not as well as it's been doing. It's about, decreased about half of what it was.
Yeah, I'm kind of in the same boat. Like everything else is red. I don't really have. Apple's 109. I got into it. I bought it before the split. One share that turned into, it's like 118 a share at the divide, and it's at 109. So down $9 a share on Apple. Lousy fang.
Yeah, exactly.
Okay. So anyway, I want to talk about this article. We here, or at least me here, are fans of Zero Hedge. Zero Hedge is one of those websites that if you don't want to sleep at night, read all of their articles. They're usually a good 2 to 3 weeks ahead of the news cycle on what's going on. And it's basically it's a reposting site. They scour, they find articles, and they all repost them in one spot. So this talks about the pre-election correction continues. Is it over? And I'm not going to read through the entire article. I just kind of wanted to do a summary of it because there's some important points here. Let's see. On Friday, due to the quad witching options expiration, I'm not sure what the hell that means. When all options contracts for the current strike month expire and roll over, the market gave up some support, and shown in the chart below. And I'm still learning to read charts, so I presume we're talking about right about here. We had a nice, there's like a little thud there. And I do have something later on in the program where we're talking about how to read candlesticks. I kind of want to go over too. So that's what's going on there. And however, as shown, the markets are very oversold short term. So a tradable bounce remains very likely in the next few days. So we could be seeing that now, or we're kind of getting to the bottom here in the beginning of the week. There could be another uptick before the week is out. But the main thing that I want to go over here is presidential elections and market outcomes. There's a fair bit of concern about the upcoming election, given the rampant rhetoric between the right and the left. Such is not surprising. The Republicans claim that Biden will crash the market. The Democrats are just the same with President Trump. From a portfolio management perspective, we need to understand what's happening during the election years to stock markets and investor returns. Okay, so then it says here, a little call out. Since 1833, the Dow Jones Industrial Average has gained an average of 10.4% in the year before a presidential election, and nearly 6% on average in the election year, which is this year. By contrast, the first and second years of a presidential term see an average gain of 2.5% and 4.2%, respectively. A notable recent exception to descent election year returns is 2008, which we had the big, huge financial crisis when the Dow sank nearly 34%. And the returns and all the information here are based only on price. They exclude dividends.
So we should elect a new president every other year, because that's when the stock market does the best.
Well, if you look at the average there, it says the gains on first and second term years of the president's term, you can average them 2.5, 4.2. Whereas on the previous year before an election cycle, we're getting the bigger benefits. To me, the way I'm reading this is, once we've had a president for a while, it gets used to the economic situation and the market rises. Once we get into an election year, it kind of goes back a little bit, and then we kind of have a little bit of a small rebound. So I would almost argue we need to keep the same guy for 8 years, so that the market gets used to it, and then we can maybe even see higher gains before we elect somebody else. But I mean, that's just me. Just reading this.
Yeah, you're right, because I was looking at it the opposite way, where the first couple years it's down. But yeah, because it looks like the market really gains steam right like the year before an election year. So yeah, you're right. A longer term would be a better market.
I don't know what's going on to happen, so I'm going to hold back a little bit.
Yeah.
It just seems like every time politics, the election comes up for any election, the market has a bit of a pullback because we don't know who's going to be in charge. The two parties are so radically different.
Yeah.
Well, for the most part, economically, they're not really that different because they're both like still all in on this Keynesian crap, where it's just inflate, print money, modern monetary theory times 10, whatever the hell they're doing now. And neither party has done anything any different. And it's been that way for a while. I would say Obama really kind of put the pedal to the metal, because we kind of saw an end and under Obama's administration to a balanced budget amendments. We haven't heard anything from either Democrats or Republicans about balancing a budget. And these things always it always plays on the market. It always plays on finances, on the value of everything, because it creates uncertainty. So we start to see, like, I think going back to, we were talking last time about the Snow IPO, that if you actually get into the details of that. So basically what happened with the Snow IPO, it originally was going to drop at a price between 110, 120, 100 to 110 was the range originally listed. insiders bought this for about $5.50 a share leading up to the IPO. Then the IPO came out at like $2.50. Webull suspended it for a little while because I was watching it, and I'm glad it suspended it, and I'm glad I missed out on buying it because I was going to buy like one share. But seeing the fact that this was basically an insider trading scam, I mean, and from all aspects, that's what it looks like. Because in some of their press releases, they said they didn't need the money; they were just going public because they wanted to go public. And so what it looks like is they were going public so that a bunch of insiders could benefit. Now, we won't know if this is true or not because you got 90 days. You have to hold on to IPO for 90 days before you can sell it off. So we'll see if these people start cashing in at 90 days that bought it for $5 a share, these hedge funds and stuff. See if they keep dumping. Warren Buffett was all in on this. So he put tons of money into these $5 shares of this $250 stock. And yeah, so it kind of seems like they used, like Snow was being used, or a willing accomplice to do a big, just giant wealth transfer here.
Yeah.
At least that's my read on it.
And right now would be a good time for them to pull something like that because so many people now are investing on different apps and everything like Robinhood and Webull and everything. So,
yeah.
You know, it makes sense that it could have been a huge scam.
Kind of continuing in this article, it talks about if policies matter, and the short answer is yes. However, policies don't matter in the short term. Presidential platforms are primarily advertising to get your vote. As such, a politician will promise many things. In hindsight, rarely get them accomplished. We've seen that year after year after year.
Yeah.
I think Trump's the first person who's actually tried to do any of the stuff he promised. And he's had roadblocks every step of the way. But I mean, if you actually look at the policies, which that's one of the things that really ticks me off about the way elections have become since Obama and post-Obama. Nobody talks about policies. It's all team sports.
Yeah.
I would love to have a discussion with somebody about what I don't like about the Trump administration policy-wise, but I can't have that conversation because everybody just wants to play team sports with it, talk about the person and all of this, largely made-up drama on TV news. It's like National Clickbait Association or whatever is going on with all that. And we don't actually talk about policy. We don't educate ourselves about policy. So behind the scenes, people like the central bankers can just do whatever the hell they want, and they manipulate our currency, and things get tanked. So, but I'm getting off on another sidetrack. I want to finish up with this article. Importantly, note in both cases, the slump in returns during September and October stated above that the current market correction falls nicely in line with historical norms. So if you go back and read the history of the market, for the most part, things look like they're pretty much on track to be kind of the same way. Now, here's the meat and potatoes of this article was pretty interesting. The Great Divide. While you may feel strongly about one party or the other when it comes to politics, it doesn't matter much when it comes to your money. Such is particularly the case today. For the second election in a row, voters will cast ballots for candidates they dislike the less, not whose policies they like more. Again, we're not talking about policies. It's a popularity contest. What the market already understands is that with parties more deeply divided than any other single point in history, the likelihood of any policies getting passed is slim. 2017 was the latest data from a 2019 report. The gap is even larger currently as social media fuels the divide, which you were mentioning in our pre-show before you were watching this Netflix thing about social media and its impact on politics and the divide in the country.
Yeah. There's a documentary about it out, and it's crazy. Like some of the social media platforms, they have enough power to where they can influence elections, and they were even talking about like they have enough influence where they could get people to overthrow a country if they like Zuckerberg put his mind to it,
Yeah, the Blaze did something similar too, where they're talking about how big tech is trying to influence the election. And you look at something like Google. Google works with China to create their social media over there, their social credit system, to where if you say something bad about communist government, you don't get a job, you don't get paid, your social credit score goes down, and you're shunned by society. I mean, that kind of power no entity should ever wield that kind of power over a sovereign individual.
Yeah.
Okay, so we got two charts here, 1994, 2017, which illustrates the divide. 1994, we were much more common ground. 2017, we are on opposite poles, basically. The one thing that markets do seem to prefer is political gridlock. I would say we all benefit from political gridlock. The less those asshats in Washington do, the better off we are as Americans trying to live our lives and run our businesses.
Exactly.
Split Congress historically has been better for stocks, which tend to like that one party doesn't have too much sway. Stocks gained close to 30% in 1985, 2013, and 2019, all under split Congresses, according to LPL Financial. The average S&P 500 gain with a divided Congress was 17.2%, while GDP growth averaged 2.8%, according to USA Today. And so we see down here Republicans, 13 when Republicans are all in charge, averages 13.4%. When Democrats are all in charge, averages 10.7%. When it's a split, averages 17.2%. So at least there's some positivity there. It's not a risk-free outcome. What we can derive from the data at odds suggest the market will end this year on a positive note. However, such says little about the next year. If you go back to our data table above, the first year of a new presidential cycle is roughly a 50-50 outcome. It is also the lowest average return year going back to 1833. Furthermore, from the election in 2021 outcomes are overly dependent on many things continuing to go right. So they list some things that need to go right. And I got to tell you, one of these isn't going to happen. All right, so number one is they need to avoidance of a double dip recession. Without more fiscal stimulus, this is a plausible risk. Number two, the Fed continues expanding monetary policy. There is currently no indication of this. However, historically, small time in recent history, this is what they're doing. They're continuing to print money. So that's probably going to happen. Number three, the consumer will need to expand their current debt-driven consumption. This is not going to happen. This is a risk without more fiscal stimulus or sustainable economic growth. So basically, in this point, they're saying, if the Fed don't send us more checks, we're not gonna be willing to go in debt and buy that new TV. I think after this whole COVIDiousy time period, you got to be really stupid to be extending your credit card debt at this point. Like really brain dead stupid to be like, I got a new balance on a new credit card. I'm gonna go buy me a whole bunch of new stuff.
Yeah.
It's insanely idiotic after what we've been through with all the uncertainty. You have to be completely uninformed to be that type of person. And there's those type of people, they'll go out and spend $800 on a pair of kicks because they got a Discover card or some crap. But large scale, that's not going to happen at all. And so we're not going to see sustainable economic growth because people are spending debt. Before there is a market improvement in both corporate earnings and profitability, this is likely going to be the case as mass layoffs will benefit bottom line profitability. However, top line sales remain at risk due to items number 1 and number 3. So they're saying basically, unless there's stimulus and unless people start spending debt, those are the two things that are going to have to happen for the market improvement on sales. So basically, the only benefit that's assured here is going to be because of mass layoffs. So again, this is one of those things we don't like to have happen. Your stocks will go up because companies are going to downsize, lay off people. Those layoffs, those people aren't going to be spending any money anytime soon. So it's like only people who are investing in the market are going to benefit at all from this. This is another rich get richer scenario. Number 5, a sharp improvement in employment, rising wages, failing job claims will signal sustainable economic recovery. We were having this up until the COVID crisis happened. That was the exact case. There was huge employments and unemployment. I think black unemployment was at its all-time lowest ever in recorded history. Lots of employment scales were through the roof, and then we had the COVID-19 thing happened, and that's what's tanked everything. So unless we get past that narrative, we're not going to have a sharp improvement in employment and rising wages. And that's largely number 5 is going to depend on how the election goes.
Yeah.
Really going to depend on how the election goes. Okay, so what does all of this gobbledygook mean for your portfolios? If you're listening, you've got a Robinhood account, you don't have much money in it like we do. Hoping that money stays here. What can we do? Portfolio positioning for an unknown election outcome. Okay, over the last few weeks, we have repeatedly discussed the idea of reducing risk, hedging, and rebalancing portfolios. Part of this was undoubtedly true due to the overly exuberant rise from March lows, potential for an unexpected election outcome, as we noted in another article called Tending the Garden. Okay, taking these actions has 2 specific benefits depending on what happens in the market. If the market corrects, these actions clear out the weeds and allow for protection of capital against the subsequent decline. Number 2, if the market continues to rally, then the portfolio has been cleaned up and new positions can be added to participate. No one knows for sure where the markets are heading in the next week, much less the next month, quarter, or year, or 5 years. What we do know is not managing risk to hedge against a decline is more detrimental to the achievement of long-term investment goals. This advice continues to play well in setting up your portfolio for the election. As we have laid out, in historical odds suggest that markets will rise regardless of electional outcome. However, those averages in 2000 and 2008, investors didn't get the average. So again, in 2000, we had the dot-com burst. And then in 2008, we had the financial collapse of the housing market and all that. Okay, so holding a little extra cash, increased positioning in treasury bonds, adding some value to your portfolio will help reduce your risk of a sharp decline in the months ahead. Once the market signals an all clear, you can take your foot off the brake and speed to your destination. Of course, it never hurts to wear your seatbelt. So basically what they're saying here is that we need to, I'm not ready for that yet. So what we need to do is make sure that you are properly, don't have all your eggs in one basket. Hold silver, hold gold, hold stocks, hold other assets, buy in some crypto. Just kind of spread what money you have around. So if one thing tanks, you've still got the others there, and then you're hedging your benefits. So that's basically the article is saying, have a little bit of hope because largely it doesn't matter what happens with the elections. It's still eventually going to grow, but just in case, make sure that you have a well-balanced portfolio. You have lots of different asset classes. Any questions, Trico?
No, it covered it. So yeah, basically kind of what's always recommended is just diversify. Don't put all your eggs in one basket. And sounds like it's good. Like normally I don't hold on to a lot of cash because it doesn't give me any return. So, right. But on here it sounds like you might want to kind of hold on to some extra cash. So that's something I got to work on.
Yeah, and I have a little bit set aside, but I need to add to it because I borrowed from it. Basically, don't keep it in the bank. Like because the banks aren't. In a previous episode we talked about how the banks aren't guaranteed to keep enough cash in their bank in case there's a run on it. You may not get your cash. So go ahead and start taking some cash out now. Do like dollar cost averaging, put $25 into your portfolio, put $25 in silver, put $25 in your pocket or under your mattress at home, that type of thing. If you're not already doing that kind of thing now, start doing it now and just kind of, spread it out so that you have some sort of safety net wherever you go. That's pretty much the end of that. Okay, so I want to transition now to a new tool that my neighbor turned me on to. Now, I'm just starting into this tool. Like I said, I'm still kind of educating myself on how to read charts. It is called TradingView. TradingView, the fastest way to follow markets. They have a free trial. They do have a paid thing as well. There's lots of different functionality into this. We have a link in the description for checking it out if you want to check it out. Like I said, I'm just dipping my toe into it now. But my neighbor was telling me that basically this will help you know when to buy, when to sell. Gives you all these different types of charts to read. And so learning to read charts, learning to look at these things, and learning to use different tools is something that you want to keep going if you're going to grow in investing. Now, here on Broke Money Hustle, we kind of recommend these steps. Start with acorns. Set it and forget it. Those Vanguard exchange traded funds are really good. It grows very well. My wife and I's recovered after the March bust. We recovered really quickly. After the short-term bust, like a week or so ago, we recovered pretty quickly. That's been a solid investment. So start there. If you want to do individual stocks, look at Robinhood, look at Webull. We have links in the description below. You can get free stocks from either one of those. And you can start to add in individual company stocks, start buying stuff that pays you dividends, look into those types of things. To continue your education, you need to learn how to read charts. You need to learn how to look at the data more and start doing kind of your own DD. Now, for me, I do a lot of DD on Twitter. I look at the comment section under individual stocks in Webull and see what other people have there. And I've kind of learned from that, but I know I need to take onus on myself to learn these things. So I started out with learning to read charts with candlesticks and found a really good video that I kind of want to skim through from OTA Academy. This is on YouTube. There's a link in the description as well, talking about candlesticks, the psychology of bulls and bears, with Merlin Rothfeld. Somebody named their kid Merlin. That's pretty awesome. Okay, so this is a 36-minute video. He starts out with kind of the history of candlesticks. It comes from Japanese candlesticks. This was like a rice trading market back in feudal Japan. And that's kind of where the concept came from. So I kind of want to skip around a little bit, but let's start out with his little introduction here and see what he has to say.
Excited to be with you today. One of my favorite topics in trading is actually looking at candlesticks. And when we look at those on a price chart, it's rather simple. We see all these colored little bars out there, but what do they actually tell us? Well, I'm going to start off by going back through history and looking at how these came to be, why they're so important, and why they are so much more than just reading price. It's really a behavioral analysis tool, and we can start to understand how buyers and sellers are thinking and the emotions behind that. That gives us a competitive advantage. Now, we're streaming live out there today, so we'll be watching your chat as it comes through here today. So please feel free to keep on typing in your chat and questions as we go, and I'll try to get to all those. Now, as a quick little precursor here, of course, we've got a disclaimer there. I'm going to do like one of those car sales guys and read through it very, very quickly. No, I'm not. I'll just let you guys read it at your own leisure. So let's go and start off with a basic example. Something we all remember from our elementary school or camp days, a tug-of-war battle. Well, when we look at Japanese candlesticks, I want you guys to understand that it's basically a tug-of-war battle. Every candle starts out at an even point. There's no winner, there's no loser. But as that battle progresses, and you look here, we've got two guys on the left-hand side, we've got two lovely ladies on the right-hand side, we can start to base our assumptions about what's going to happen. And and lo and behold, we go here and we get back to that one. There you go. You see all of a sudden, the guys are just crushing it, right? They're pulling, they're getting the girls almost all the way past that line, so they're just about to win. But the battle's not over yet. And for whatever reason, whatever circumstance, those girls just dig deep. They plant those heels, and all of a sudden they start pulling and pulling and pulling, and they start to win this battle. And at the end of it all, when the bell rings, when the whistle blows, the girls have won this battle. So regardless of what your preconceived notions were going into this battle, there was a period of time where the men were winning. There was a period of time where the women won. But ultimately, at the end of all of this, the ladies won. And that tells us a little bit about the psychology going into that situation. So that's kind of how we're going to focus on this. I want you to think of it as a battle, a war between participants. Now, in the real world, it's not about you and me or, any other specific trader. It's all of us combined. So how did it all start? Well, we can go way back to the early days here. This is what's called the Dojima rice market. And really in 1710 is when they went to a futures market, because it used to be kind of a actual hand-on rice type of market until 1710. And then it went to a futures type of exchange. And this is a classic picture we found of the Dojima rice market. Now, one of the traders that emerged from that, and it really is kind of known as the father of Japanese candlesticks, is a gentleman by the name of Hama Manahisa. Again, I put on there the father of Japanese candlesticks. I'm pretty sure he's actually an honorary samurai, by the way, just for those who want to know. Because he was so good at Japanese candlesticks and trading, they made him an honorary samurai. And I don't know about you, but I'm thinking an honorary samurai should be able to swing a sword pretty good. But it's brand
Okay.
new to this.
I'm gonna
So
skip
can we
ahead a little
start
bit
off with
here.
the candlestick chart quite yet? Now, every bar of information really gives us 5 pieces of information. And of course, you're looking at this going, I only see 4 words on each one. Well, the left hash mark there represents where it opened. You can see the low, you can see the high, and you can see the right hash mark is where it closed at. So those are your 4 pieces, but there's one more, which would be the range, and that's simply the distance between the high and the low. Those 5 components are what make up all bars and candles, and they give us a good insight as to what's going on with price and psychology. Now, if it opened lower, if it closed higher than it opened, then you're going to see an example of what we have on the left here, which is a bullish candle, which would be a white real body. And then if it closed lower than it opened, you'd have a black real body. Now, the way that Japanese candlesticks were traditionally done were in black and white. Nowadays, it's changed to red and green, which is somewhat ironic because trading is pretty much a male-dominated world. It is definitely changing, and happy to see that, but still predominantly men are traders out there. And it's red and green, which I believe something like 19% of men are colorblind to red and green. Could we have picked different colors? All right, the real body is the piece that was just colored in here, and that basically takes the difference between where it opened and where it closed, and based off what those numbers are, it will either make it white or black or red or green. Now, the white candle obviously is going to be green for up, and your black candle would be red, meaning it closed lower than where it opened. Those are the very, very basics of candles.
Now, for those of you who trade with Robinhood and you see red and green a lot, and I think other platforms probably do this too, that's where they're getting this information from, is based off of the red and green of the candlesticks. As far as I know, that's exactly where. So when you see something that's red, it's closing lower than it opened. When something's green, you might still be losing money, but it's actually closing higher than it opened.
So we can start by looking at this chart here. Doesn't matter what security this is or what time frame it is, but you guys can see we've got a lot of black and white candles there. And very clearly, when we get a nice streak of black candles out there, it gives us that kind of negative connotation. We feel like there's a downside move there. You see somewhere there's a lot of white candles in a row, and that leads us to a nice bullish move. Well, most platforms now will look like this, with mostly red and green candles. Now, of course, we can change these to fit our color scheme at home. I like to use black and white candles simply because it's easier for me to see, because I'm part of that 19% colorblind. Now let's break up the individual candles, right? You got a basic understanding. They represent buyers out there, they represent sellers, and we get 5 pieces of information. Here is where we want to start to focus on the psychology of candlesticks. So here we've got 2 candles, one showing buying pressure, one showing selling pressure. And you're wondering, well, why does that one on the left show buying pressure? Well, if you'll notice, the candle on the left is a white candle, meaning that it opened at the bottom of that white box and closed at the dead high. So that's kind of bullish, right? But more important is what happened during that range. So take a peek at this. During this time frame, let's say this candle represents 1 day of trading. You can see the price was aggressively selling off. At one point, this was a giant black or red candle because it was sold all the way down to those lows. But going back to our tug of war analogy, this is just like what we saw at the opening of this presentation. The buyers came back in, and for whatever reason, you could explain it till you're blue in the face, doesn't matter. The buyers came back and pushed this up all the way to the high of the day. Very positive. So if we go back to a simple analogy of you and your significant other are in an argument and you're fighting about something, you can pick whatever topic it is. What's the most important word to have in that argument? It's the last word. And
It's true.
sorry, or have some flowers. But really, it's the last word in this Japanese candlestick is, in this case, was buyers pushing it up. They're the power, and that's the momentum at that point in time. On the right side of your screen, you see the inverse of that, where at one point we had a string of buyers pushing this thing up, right? It was a nice green candle. It was a white candle, depending on which colors you use. I'll use red and green from here on out. But it was a nice green candle, and who knows why, but the sellers came back in and not only sold it all the way back down to where it opened, but even lower and closed at the dead low. This is a sign of a very, very bearish pressure out there. And depending on where these candles happen, where they show up on a price chart, can give us some high probability trading tactics. So let's look at these 6 candlesticks out here. Normally, what I would do is I would ask you guys to, quiz and say, oh, which one do you think is the most bullish? Which one do you think is the most bearish? Well, I'm going to just read through these and kind of explain them briefly. Number one is probably the most bullish, right? It opened at the dead low. There's no tail at the bottom of it. So it opened at the dead low, closed at the dead high. Very, very strong candle out there. Number two, while you look at this one, you go, oh, well, it's red, so it's got to be actually kind of bearish, right? No, it's actually rather bullish because remember, just like the example we just looked at, even though the body is red, right, on number two, meaning it closed lower than where it opened, it still closed at the high end of its range. And if I asked you who had the last word in that battle, it was the buyers because it was at one point an all red candle all the way down to this low. But for some reason, those buyers pushed it back up, meaning the momentum was there at the end, therefore rather positive. Number three is it's pretty bullish, right? It's similar to number one, but it has topping and bottoming tails. That's a tail is this little part here, means it went down to that price at some point and it reached this high price at some point. So you'll call those tails, wicks, or shadows, depending on who's instructing or using the candlestick. Number four is actually rather bearish, even though it's a green candle. Psychologically, we go, oh, green, positive, good. Not necessarily. Again, this is like what we looked at a couple slides ago, where you have a lot of selling pressure coming in at the end, pushing it down to near the lows of the session. Therefore, it's bearish. Now, number five and number six, I would say, are almost the same. They represent indecision. Very small, real bodies, right? You can see number five's got that small red body. Even though it's red, it still didn't have much of a change from where it opened to where it closed. Same thing with number six. That's called a doji, where it opens and closes at the same price. The only thing that separates 5 and 6 is the range. So we had a lot more volatility during that number 5, whereas number 6 was almost non-existent, barely even moved. And those can also give us clues as to potential market direction. So let's talk about that number 6 for a second. That's the doji out there. What is a doji? Well, a doji is simply a candle that opens and closes at just about the same price. It doesn't have to be exact, but a lot of people, they're true technicians, say it's got to be the same price. Well, when you're trading something like the S&P and it's trading at 2,000 plus, it's kind of hard to get it to close exactly the same as where it opened. So we like to say ballpark, pretty close. And you notice that we have 3 different representations of it out there. You see one is just like a little tiny plus sign. You have the middle one there, which got some big ranges to it. Then you have the one on the far right, which is called a dragonfly doji. And I'll explain some of the differences between those as we progress. So let's go into some of the more popular doji patterns. And again, if you have any questions, feel free to send those in here and I'll go over them. Gravestone doji is one of the more popular ones. Now, a gravestone doji is simply something that opens and closes at about the same price. That's the classic definition of a doji. Now, for it to be a gravestone doji, it opens and closes at the low, or very, very near the low. It has a long topping tail. Now, by itself, this really doesn't help us make a trade. Location, location, location. You'll hear that heard all through real estate. You hear it with Japanese candlesticks as well. If this candle was at the top of a nice sharp uptrend, then it's going to give me a good probability that prices are going to be moving to the downside. So if this is a gravestone doji, which denotes selling pressure and maybe a more bearish environment going forward, well, what does the opposite look like? Well, here we have a dragonfly doji, which looks exactly the same, just upside down. You have prices open and closing just about equal. That's right near the high. And you have that long bottoming tail there. Now, again, location is key. If we have this happen at the top of an uptrend, it's really not that important to us. If it's at the bottom of a downtrend, and especially if we go back to Online Trading Academy's core strategy and talk about it into a demand zone, now we really have something that gives us some juice to work with to a potential upside move. Now, what are some of the other ones out there? These are all called spinning tops, and really all a spinning top is a very short compressed range, a narrow range candle that they like to call them, or NRCs. Generally, what that means is you have a lack of emotion. So it stays in a very short trading range. You don't have much price movement, maybe some small wicks or shadows, tails above and below, but really it's not a lot going on, and it generally represents indecision. Now, indecision can frequently be found in areas of consolidation. So I've got an illustration here, and you'll see in that red oval there, there's a lot of little tiny spinning tops. And it's really where price was just going sideways. Again, it doesn't matter what security this is. You'll find spinning tops a lot in sideways congestion, but you can also find them at points where price is accelerated aggressively and all of a sudden it just kind of stops. Those become great trading opportunities for me as well, because that indecision could lead to buyers or sellers remorse, if you will, and instantly reversal in price direction. So those are your spinning tops. Of course, we've got the tiny little narrow ranges. We also have these big, colossal, giant ones. These are, it just says long candle. I just think the name is terrible out there. I like to call them expanded range candles, really large ranges, meaning we've moved a lot in whatever time period this is, whether it's 1 minute, 5 minute, daily, weekly, monthly, doesn't matter, but a really large candle. Now, obviously, that represents a large price move, a wide range. You generally don't have wicks with these, meaning it's going to be closing near the highs, opening near the lows, closing near the highs, and vice versa. What this represents is a lot of emotion. A lot of times you see these expanded range candles or long candles after major announcements, right? Could be an earnings announcement, could be some press release coming out, but there's a lot of emotion there, and generally it's coupled with a lot of volume. That's what's driving the price. So we can see on this chart, here's a couple examples of them. You see some really large expanded range candles. Now, again, it doesn't have to close at the dead low or open at the dead high, but it makes it more powerful if it does. In these four examples that I have here, you'll see that all of them have some topping and bottoming tails. So nothing with candlesticks is going to be perfect. It's a little bit of an artistic flair there, meaning it's kind of slightly subject to your artistic view on this one. I'll show you some examples of what I mean by artistic view here shortly. All right, so now let's go to some of the more popular ones. Here we have the Bullish Harami, which in Japanese means pregnant. And you can see by the illustration on the right-hand side, you've got price drifting down. You've got a nice big black or red candle. And then the next candle is going to be most likely green. It's preferably going to be an up candle, but it doesn't have to be. But it is going to fit within the previous range. So as you guys can see here on the screen, you've got this black candle, and this entire candle, including the tails, should fit within the real body of the previous candle. That is really the definition of a bullish Harami. So you've got the downtrend. The first candle is definitely a down expanded range candle. The second candle, maybe a little narrower range one, preferably to the upside, and it is completely engulfed by the first day there. So we can make a little modifications. And this is where I think Japanese candlesticks get rather humorous, because you have the bullish Harami, and then you have, oh, the bullish Harami cross. Well, what changed? You'll notice all that changed was the second day. Instead of it having a body, now it's just a cross, it's a doji. So it doesn't make it any more powerful, less powerful, but I want to include that here so you guys, you may have heard some of these terms out there called the bullish Harami cross or just the bullish Harami. So how does this look on a price chart? Well, we can see very clearly here, we've got two decent examples. Now, I know if some of you are masters of Nissen's book on Japanese candlesticks, which of course is kind of the Bible for most people out there that like to look at Japanese candlesticks, you'll say, well, that first one on the left side isn't exactly a Harami. Why not? Well, if you notice, I'm going to have the cursor illustrated over here on the left-hand side. You'll see we've got this, we call that expanded range candle, this black candle right here. And then we have this little doji. It's basically a bullish Harami cross. But technically, you'll notice that the tail on the doji is just slightly outside of the highs of that expanded range candle. So technically, you could argue that's not a Harami. But hey, it's close enough for government work. I'm going to call that one a Harami, because you notice it was drifting down. We also have the similar situation here. We had price drifting down, and then you have this Harami here. Even though it has a long tail on it, it still fits completely within this expanded range candle. The next day we get basically 3 days worth of upside move. So there you see some bullish Haramis on the price chart. Now, I would say the sibling of Harami is just the exact opposite, right? Harami is a big down day. We have bearish Harami as well. We'll cover both of those. But you have a big down day followed by a small little up day. Well, what if we have a small down day followed by a gigantic up day? These are called engulfing patterns. So this is a bullish engulfing pattern, what some would refer to, we talked about that in our XLT, as kind of an outside day. And really what we're looking for here is a market that's been trending down. So remember, key is location, location, location. If you have an engulfing pattern in the middle of consolidation, it doesn't mean much. If it's trending down, though, we've got a nice downtrend, and that first candle is kind of a smaller little doji pattern perhaps, but it's a negative down day. And then the second candle is this really big candle that it completely engulfs, meaning it eats up the entire previous day worth of trading. That is an example of a bullish engulfing. This is a great pattern from a reversal perspective. We see quite frequently what it represents is a change in emotion, a change in sentiment. So we have that big expanded range candle there. Prices most likely, I say most likely, not like 90%, but you have a greater than 50% probability that's going to move to the upside because where's the momentum? Where is that tug of war being won? Who's winning? Buyers were winning that day, and that momentum most likely will continue. For how long? Who knows? But it's there at that moment, and that's what's important.
Okay, I want to pause there because we're running out of time. But really good information. Definitely check out this video. There's a link in the description, and he goes through a lot more different types of candlestick patterns to look for. And I definitely want to check out that book that he mentions too, because there's a lot there. There's a lot of different ways to read stocks. But at least for me, from my opinion, the candlestick charting seems to make the most sense, at least to my mind. So that's what I'm going to focus on trying to learn first in learning how to read charts. Just with the information we've seen so far, Traco, do you have any questions or anything that popped out at you?
Yeah, it seems like because usually I don't use a lot of candlestick charts because usually a line chart's just easier for me to read. And like on the Robinhood app, if it's trending down, it turns it red, and if it's going up, it turns it green. So it just makes it easier at quick glance to kind of see what's going on. But the candlestick charts seem to tell like a more detailed story of what the stock did, like as far as opening and closing. Whereas on Robinhood, you got to kind of scroll back to see what it opened at and look at different charts and everything. Like if you look at your portfolio page, you can kind of tell in red and green what's up or what's down, but then to kind of really know what's going on, you almost have to click on individual stocks and then try and get the numbers and everything. But on here, it seems like it's a lot more information that's given you, where it's kind of telling you if it went up that day or went down that day, but it's more based on like the opening and closing of the market that day. It seems a lot more detailed than what a line chart would be. So it I think it provides better information.
Yeah, that's why I think tools like TradingView, which allows you to just pretty much get in there and read and look at the different charts. Trying to see if I can find the to tell it to do the candlesticks. There's all these tools here. I'm still trying to learn. Here we are. So here's candles. And there's 3 different types of candles. I'm just going to do basic candles. And we're looking at the Russell 2000 index. So you can see some of these different candles here that he was originally talking about. You have the long ones, which means there's a lot of volatility. There's a lot of volume going on. Whereas in the short ones, there's short ones. There's some of these crosses here where it opened and closed the same day. So as we get into this and try to learn this, at least for myself, trying to learn this, it seems like there's a lot, like you were saying, there's a lot more to get out of it to kind of gauge where a stock's going to go in order to decide if you're going to stay long or short in it.
Exactly.
So anyway, this is a tool. TradingView is a tool. And then please click on the link in the description or check out Online Trading Academy, OTA. Subscribe to them. This is where I found the candlestick chart video. They have lots of other good videos. Give them a subscribe, a like, and a thumbs up. And anyway, so we just wanted to share that with you for a little bit. He then goes into the bear candlesticks as well. So it's a full-fledged mini course on reading candlesticks. Good introduction to it as well. Before we go, did you have any stock picks, date, Mary kills that you want to go over?
Yeah. Let's see. I did a Mary today. It's one I was looking at for a long time. Realty Income. Ticker symbol is O, just the letter O.
I'm bringing it up right now. All right. This is one that I own. I own a few shares of this. This is a really good dividend stock and really solid, like grow, like park your money here and hold it forever stock.
Oh, exactly. I've been wanting to get it for a while, but I wanted to get it if I could under 60.
Yeah.
So today it was kind of hovering there in the morning, and I'm watching it, and right now, because we've been doing a lot of renovations on the house, I didn't want to put the cash in there and set a limit because I'm trying to keep some cash handy for paying for renovations and things like that. So I didn't want to put in a limit, so I was watching it all day, and then kind of later in the afternoon, I think it was around 2 or something, it finally got under $60 a share, so I bought some at $59.66.
Nice.
Yeah, it worked out nice, and it's already up $60. Yeah, $60.90. So it's already doing good. I think I missed the last dividend date, or the last ex-dividend date, but it's a monthly dividend payer, so it's a monthly dividend stock. So if I didn't catch it for the next 30 days, I'll catch it 60 days from now. So yeah, it's one I've been wanting for a while. Plus, it's a dividend aristocrat, so I got to mark another square off of my dividend bingo.
Nice. That's awesome.
Yeah.
This is a good one, like AT&T. There's a certain price level you want to hit. Like AT&T, anything under 30 is a buy. For this one, I would agree. Anything under 60 is a buy. And, good place to just park capital and let it pay you a dividend.
Yeah, pretty much. And then around the end of last week, my kill was BP.
British Petroleum?
Yeah. Because I own some ExxonMobil, and the dividends are nice. Oil companies seem to pay really good dividends. So the dividends were nice, and there was a day last week where all the
Do I have the right one up? That's BP, PLLC, ADR?
Yeah, it should just be the ticker symbol BP, right? Oh yeah, the price looks right, 1833. So there was a day last week where a lot of the oil and gas companies were their prices were down, and it seems like they always pay a good dividend. I think their dividend was over 11%. So last week I bought some on the 15th last week. But then I didn't do my DD. So after I buy it, I go on to dividend.com, check out what their dividends are, like see if I made it in time for the next dividend date, and what their dividends were for the last year or two. And on dividend.com, it said they cut their dividends. So, and me, that's kind of, and
You've incurred the wrath.
Yeah. I'm like, oh no, they didn't. So I quickly sold it. I think I made 2 cents on it. But hopefully they learn their lesson. Don't mess with my dividends. But yeah, and then didn't have any dating this week. My timing's been kind of off because I've been sinking a bunch of money into home improvements right when the stock market is like really low. So I could be buying a bunch of stuff really cheap, but instead I bought $500 worth of drywall and
Instead of a drywall company, you bought the drywall.
Yeah, exactly.
Well, my only date is Lemonade. We talked about them on the show previously. They basically are a Robinhood style app to buy insurance. Most of it's run through AI. This is still very ground floor with them. So I bought a couple of shares. Bought it at 48. And it's currently at 52.40. So it's been a pretty good positive for the week that I've held on to it. Seems like a pretty good fintech company, and I think once like millennials and zillennials kind of get an idea that this is the thing that they need I think it's sky's the limit for this company. I think it's going to go far. Not a dividend stock, of course. It's a fintech type thing. But an interesting concept, and I think it's definitely going to catch on because as you get older, you start to understand, hey, insurance is kind of a necessity, and they're really good for renters insurance, pet insurance. You can buy it right through the app. So that's kind of been my only addition since the splits, and so far so good.
Good.
All right.
It sounds like they cover a lot of different types of insurance, like pet insurance. I didn't even know that was a thing.
Yeah. Well, I guess if you pay a lot of money for some sort of pure breed, you kind of want to put some insurance on it.
Yeah.
There's no reason to insure your mutt, I don't think. But unless you really, really love them and you want to start paying out the nose to insure them. But it's one of those things. It's like insurance is a product. And if people are willing to buy it, they're going to create the product for it. So, insurance.
Yeah, no one tell my wife there's pet insurance. We got 2 cats and 2 dogs. We'll go broke.
But great little company, and I'm still loving my technology stocks, even though they were beating me over the head today, down wise. Because it's one of those things. Is like you've just got to stick into it for the long haul. Nikola taking a big hit down to 27.30. I've lost 20% off my investment with Nikola, but GM is still involved. There's still a lot of news out there in the cycles, so I'm going to keep hanging on to it and just kind of see where things go. I did buy another share of AT&T, kind of added to that. That's just another one, kind of like how you're doing with some of your other dividend stocks. AT&T is one of those where it's, hey, it's under 30. Oh, got another share here and there.
Yeah. And I think my dividend plan is or strategy is working, because I notice as I get more every day now, I'm getting a different message from Robinhood saying, because you owned a share or a couple shares of this or that stock by this date, you're getting a dividend reinvestment thing. So I notice it's getting to where every day or every other day now I'm getting a dividend. So that's really nice to see, especially when the stock market's down. At least I'm getting something.
Awesome. Well, anyway, we're a little bit past what our usual goal is for time-wise, and I want to thank you guys for checking us out wherever you're checking out podcasts, whether it's Google Podcasts, Apple Podcasts, or Spotify, which, according to Anchor, is where most of our listeners are listening at. We also want to thank our friends on the Indie Bolt Network who carry us on Thursdays during their block, and thank everyone who joins and listens in. And it's awesome to be a part of that network as well. Anyway, so please share this podcast with your friends. If you're out there, if you've got a side hustle you want to talk about, if you've got a business that you run, small business opportunities, if you're just a new time investor, you want to talk about that, hey, we'll vet you. Send us a DM. You can look us up on Twitter at Broke Money Hustle. Oh, wait, it's at Broke Money on Twitter, Broke Money Hustle on Instagram, of course, the YouTube and Facebook. All our DMs are open. And we'll vet you. We'll take a look at your background and see if you're good to go to come on the show. We don't want any business scams. We know there's a lot of that stuff floating around. So that's really kind of all we look out for.
Exactly.
Some sort of like real hustle, not a side hustle, but just like, a dirty hustle. And but so far so good. All of our guests have been great, and we definitely want to thank you for tuning in. Trico, do you have anything before we go?
Wanted to give a shout out to my friend Victor from Mexico. He's been a friend of mine for a long time. We went to the 6th grade together, and he started listening to the show, and it's really cool because he's a financial advisor down in Mexico. So it's really cool kind of getting a different perspective on everything.
Okay, so, you got to try to get Victor as a guest then.
Yeah, I already warned him. I'm like, we're going to call you on one day.
That would be terrific. So see if you can hook that up, and that'll be great, especially for Indie Volt listeners in Mexico. I know we have some. So
yeah. Yeah, I think it'll be really cool. I already warned him. I'm like, you got to come on one day, and he's like, that'd be cool, because he's a fan of the show too. So
Okay, that sounds like a yes.
yeah,
Book it.
yeah, and we must be doing something right if a financial advisor is not like correcting everything we say. Yeah, because he said he liked the show, and yeah, he didn't kind of shake his head and be like, "What are you doing?" like I figure he would. You know?
Yeah, no kidding. I look at my returns on my portfolio. It's like, you know what? Should I be even on a show? Should I be talking?
Yeah.
Anyway, again, we're just two regular guys. We're not financial advisors. So please contact a licensed actual financial advisor, someone who does this as their day job, if you're going to put any big money into the market. If you're just curious, if you want to check out Robinhood Webull, click the links below on the YouTube page and get a couple of free stocks there. But if you just really want to park your money someplace safe, I highly recommend Acorns. It's been a great investment for my family. And they have a lot of things on there like a Roth IRA, which I'm going to encourage my daughter to get into once she turns 18. Start putting some money into that. And you can retire early. All right. So my name is Eric, my co-host TJ Trico. We are done. Thank you for listening to Broke Money Hustle.
This is Broke Money Hustle.